I was listening to Ben Bernanke, former Fed chair, of course, saying it's not like the Depression. This isn't going to last for 12 years. But he did say if all goes well, in a year or two, we should be in a substantially better position. Do we have to start thinking about things over that kind of time horizon?
Well, I think I think that's right. We do believe that we'll get out of this and the recovery will be quite strong. But the dip in the meantime is pretty significant. I mean, to give a scale of it, we're looking at US GDP falling by 6.2% this year, 9% across the Eurozone, and globally a contraction of 1.8%. That's in GDP terms. And we're expecting earnings to fall by about a third in the US and by 45% across the Eurozone, by over 20% across Asia. These are very big numbers relative to even other recessions, the financial crisis and others. But because this is effectively a stopping of demand from which there should be a recovery, so long as there isn't too much second round effect damage in the economy during the period of lockdowns, we would expect quite a strong rebound after. So earnings picking up next year by 50% plus in the US and Europe, and alongside that, some improvement in dividends. And it's that improvement into the future that the market is not yet really reflecting, particularly on the dividend story. But we do expect to see global growth next year rising by over 6%. It won't take us back to the starting levels, but I do think that that's a prospect which will trigger, we think, quite a strong rebound in equities, but from a lower level than they are currently.
Peter, how can that be when you have companies and consumers around the world that are now that are getting no income, no revenues, and getting loaded up with debt that has strings attached? I mean, on the other side of this crisis, they're going to come out. They're going to come out with more debt than probably they've ever had before. Mm-hmm. How does that drive the economy? Well,
I think, again, we need to be careful making a distinction between growth rate and the levels of growth. So from a very, very low base, effectively, you have large parts of main economies in mothball doing nothing at all. As you get some relaxation of mobility, demand should pick up and you should get quite a strong growth rate. But you won't get back to the previous trend rate of growth for a very long time, and that would be true for profits as well. So even though, for example, we expect earnings per share having fallen 45% across Europe this year, to give an example, and a 50% rise next year, even by the end of the year after that, the actual level of earnings per share would still be below the peak that it reached back in 2007. So I think there's a difference between the growth rate from a very low base and then the sort of pace of growth thereafter. But to your point on taking on debt, which is true for many companies and, of course, the governments themselves, I think this does serve as well to demonstrate the importance or the value attributed to companies with strong balance sheets that at least will be in a position to be able to generate stable cash flows and pay dividends into the future. These companies are benefiting on a relative basis. That's true in the credit market as well as the equity market. And while that's understandable in a time of great uncertainty in a recession, we still think that will be true coming out of this for the reasons that you suggest.